India has more than 1,000 individuals across 122 cities with a wealth of more than 1,000 crores each, as per one of the wealth reports that I had read in 2022. In fact, India's HNI population is expected to grow by more than 77% from 2020 to 2025, and ultra HNIs are expected to grow by almost 40% during this time period. Clearly, this growing tribe of high net worth individuals, in order to grow their wealth and preserve it, would need more value addition and expertise in wealth management solutions, teamed with seamless execution and digital support. No doubt, they are approaching the professional money management services, but not just any money manager. They are seeking the service of specialists. I'm excited to have conversation with such a specialist today in this episode on One Step Ahead show by DSP Mutual Fund, who will help us understand the changing landscape of wealth management in India, what kind of financial solutions to look for, what processes to follow, how to manage risk, and how to stay rich. I welcome Adietya Chopra, who is the founder and CEO at AKC Capital and based out of Bengaluru. Adietya is a certified financial planner and has more than 19 years of experience in the financial services industry, of which 15% has been in the field of wealth management and private banking, and he has been advising and managing investment portfolio of corporates and ultra HNI clients. He provides strategic direction to AKC Capital. This includes the firm's vision, growth strategy, and he also works on engagement protocols with clients and all stakeholders. Welcome to the show, Adietya.
Yeah, thank you, Savanna. Thanks for inviting me on this platform and looking forward to this interaction.
Absolutely. But before we start the conversation, I request all our viewers to share their questions in the comments section, and we shall get back to you at the earliest. So Adietya, let's begin with more about you and AKC Capital. You have worked with professional groups for a very long time before this. What made you start your own venture? Tell us about your journey.
Yeah, so I have been, as you rightly mentioned, I have been in the industry of private banking and wealth management for close to 17 years plus. And AKC Capital was a natural extension to that post this work experience. So we founded AKC Capital in April last year, 2022, to take this journey forward. And with the single important agenda of advising HNI and ultra HNI clients and families on their investment portfolios.
Great. So how large is the company, and how many investors of the firm has, and what's the profile of the investors, if you can tell us?
Yeah.
Also, if you tell us, do you have a lot of clients who inherit a lot of money, and if their mindset is a little different than the usual clients with the inheritance factor in mind, and do you advise them differently?
Yeah. Thanks for the question. So, so we've set this firm as a private limited company because we felt that a legal structure always inspires more confidence than an individual or a proprietary firm. So today, as we speak, there are 3 directors in the firm, including me, and we are managing almost close to 200 crores in assets under management, and this would include all asset classes across mutual funds, direct equity, PMS, and alternate investment funds. Right. So that's where the current construct is in terms of where we are, and obviously as we grow forward and the industry growth, we would like to grow our asset base to 500 crores plus for the next 3 to 4 years. Coming to the next question, which you had, is in terms of, how do we handle clients who inherit money, or they have really got that kind of money, without any, suddenly. So obviously, my personal sense is that, this is a money which comes all of a sudden. So we feel that sometimes the clients may not have that kind of seriousness because it's a money which has come easily to them via inheritance. So I think the first thing which we'd like to tell clients is that how to manage that portion, and that's where the essence of financial planning comes in, and we kind of try to walk them through a more of a process-based approach, which is step one in terms of quantifying their financial goals, and quantification is an important element here because when you have a number to it, it's easy to relate to it. And more importantly, what time horizon you would like to have to achieve these goals, right? Once you have these numbers in place, then we would work with them in terms of investment plan, including review of the existing portfolios, then have a holistic discussion with them as to how this plan is going to work for them and the family. And then there's a process of review which gets built in. But I think an essential element is really of the behavior that you want to have to such assets which are acquired, because the point is that you've not really worked hard for them. It's on the platter. So I think it's very important for a professional firm like us to also advise the clients that to not to take the money for granted, and have a proper structure around that, the costs and the tax efficiencies around that, and a process. So once this kind of gets built in, I think you have a stronger connect with the client.
Great. So I'm assuming this is the robust process that you follow for your overall client profiles.
That's right.
Right? Great.
Yes, absolutely.
Great. So are also HNI clients generally more conscious about potential losses, and how do you deal with them, and how do you communicate to instill confidence in your suggested strategies to them?
Yeah, so see, by nature, by human behavior, by nature, anyone would be afraid of potential losses, right? So be it an HNI client who is, well averse of the financial landscape, or a person who has come, has no knowledge of it. Anything about a loss or unknown is always a significant barrier to thought. So I think coming back to that, we really would like to, bring in about an element of education to client. Like I said, the first thing is the process reiteration, which I just covered earlier. Mm-hmm. And tell the client that the element of risk is there in all decisions we take in life, be it personal, professional, and obviously it has an impact on your finances as well when you're investing. So very important to first let them understand the inherent nature of risk. And it's very important, especially in the Indian context, to tell clients that even your fixed income assets could be prone to risk, right? Not only equities, because you have interest rate risk there, and if you don't understand that, even your fixed income can be more volatile than equities at times. So the first is to tell them that there's an element of risk involved in these decisions. However, it's equally important to know that if you have a dedicated time horizon to achieve your goals, then the element of risk actually reduces with time. And statistically, the standard deviation, tends to significantly reduce over a decade. The point I'm trying to make here is that for equity assets, they should have the requisite term horizon of 3 to 5 years. And even in fixed income assets, while you could have, 8 or 9 subclasses there, it's important what time horizon you're putting even your fixed income investments to work. Once you understand that, then the very nature of volatility or any event specific or any factor which contributes to volatility in the markets, clients are in a better position to, number one, understand that. And once they understand that, we are able to, manage that, situation more easily. Second thing, which is more critical here, is effective communication. I think I've seen in my career that, the biggest barrier to a client, trust is if you don't have effective communication. So we strongly believe that when the times are good, you should communicate anyways. But when the markets are tough, that's the time you should have a much stronger effective communication. And that instills confidence and accountability. So I think these two elements of understanding the risk and effective communication is important.
Absolutely. So I can clearly understand that your logical reasoning and effective communication, and also on-time communication, have helped you a lot to deal with
Yes,
such clients.
absolutely.
I'm sure you have been facing a lot of challenges also with these clients each day. Would you want to share some of your memorable instances for the benefit of our viewers? And how did you successfully resolve such matters?
Yeah, so I think when it comes to wealth management or private banking, as we call it in India, especially in the ultra HNI space, or I would say to a large extent HNI clients as well, I think the biggest barrier to any constructive engagement is trust, lack of trust. Let me put that way, and that's all the more true when you're acquiring a new relationship, right? So, in my career spanning close to 18 plus years, how do you establish the trust, the rapport is important. So, while that's a challenge, so one way of which we felt to overcome is that, uh, you know, uh, tell them that we've been in this space, we have a requisite experience. So, to handle the kind of intricacies of the portfolio, that kind of works at times. But I think the biggest way you can overcome this challenge is by, positive references or words from existing clientele. So that has really worked in situations like this, where the existing clients have put in a positive word that they've had a reasonably good experience. That really helps us to overcome this impediment. So that's one. I would say the second concern across clients would be here really how do you access your uh, portfolios? Because once you've invested, so you need an efficient mechanism to track your portfolios wherever you're in the world. So I think bringing an element of technology or the architecture or the infrastructure that we have which they can leverage to not only do the investments online, but also track the investments on the go becomes also a great comforting factor to convince the clients. And I think that's all the more important in today's landscape where technology is really the driver. So I think these two things work, and we've been able to effectively demonstrate that we are investing in technology. We are committed to investing in efficient technology, which will help them not only invest and track their portfolios. So these two things have worked well for us. And I
Great.
would say to a large extent, it would be useful for the audience as well.
Right. So it really helps, positive word of mouth and digital convenience is definitely something wealth managers should aspire for and, should
Yes.
be practicing. At some point in time, you did mention about financial education. And given our past interaction with you, I know you are quite passionate about financial education. Do you believe the rich HNI individuals, they want to be financially educated, or do they come with the biases having made so much of money? Or in general, do you feel that they're equipped enough with all necessary information? What's your take on that?
So I would say I would go for a mix of both. So most especially in a city like Bangalore, I can take that example. So it's a city which thrives on technology. So you will have a lot of clients who are very tech savvy, but that need not mean that they are financial savvy as well. So that is where you would like to bring in an element of education, and bring in the sense of financial planning and and typically goal-based financial planning. So I think that's where you would need an element of advice, education to really understand why this whole exercise of wealth management or financial planning is important in the first place, right? And clients appreciate that, right? You have the other set, which is there, who have typically have had experience in managing the money. You really don't need that element of education, but the biggest impediment, like you said, have your own set of biases, and biases do at times cloud your sense of judgment or how you view things around you. So it becomes very important as wealth managers or relationship managers to let clients see beyond those biases, right? It could be a recency bias, it could be any kind of bias which could, be an impediment to, to look at your financial portfolios in a more objective manner. So in that case, the strategy would be more of, reviewing the existing portfolios. And because we've come with a certain amount of experience in the market, we could share our best practices which have worked, but more importantly, I think for these clients, we would like to listen a lot more as to what they're saying. So I would say that the strategy is really 80% hearing and 20% speaking. Now, when I'm wearing that hat on, I'm really absorbing a lot of information, and then we are able to tell the clients what portion of that information is factually correct, which is probably not, and tell them the right way to move forward. And that makes the discussion a lot more holistic and constructive and takes the engagement forward. So I think these are both spectrums of the clients, both exist in a market like Bangalore. And if I were to extrapolate to a country like India, I would say that you would get nuances of both sides.
Absolutely, Aditya. In fact, while you were talking about the biases, I could very well recollect and actually, remember my conversations with so many participants in our financial wellness sessions that we do across the country with different corporates. And I guess these are some of the trends which are quite similar for majority of investors. For all the viewers here, we have a lot of more interesting questions coming up. But before that, if you enjoy our content, please like the video, subscribe to our channel, and press the bell icon to get the latest video updates from DSP Mutual Fund. So Aditya, my next question to you is on mutual funds. Can high net worth individuals build their portfolio based solely on mutual funds, and do they do that?
So, well, I'll answer your question. That's a good question. So technically speaking, it's very important that before we answer that question, first is that yes, technically a HNI or ultra HNI client can build their entire portfolio through mutual funds. That's factually correct, right? Because mutual fund as a vehicle offers you access to equity as well as a fixed income space. But what is more important here is that in line with the emerging landscape, financial landscape, you need to understand, the client's risk profile. And I was just like, saying you should understand what his behavioral traits could be, and in terms of his approach to different asset classes. Now, when you understand, especially the behavioral traits, and his risk profile, you get a lot more data, which would throw up like that, maybe he has some likes or dislike on asset classes beyond mutual funds, right? So that is something which is important because you do not want to miss that piece of information. So while clients would technically build a portfolio around MF, they would probably also want to aspire to have, alternate assets or emerging asset classes in their portfolio. And that's a piece of information no wealth manager would like to ignore or miss, because ultimately it's a client requirement which you need to fulfill. So when you realize that, then you can increase the bouquet beyond MF, bring in alternate assets, and within alternatives, you could have portfolio management services, you could have alternative investment funds, and you could also have private equity / venture capital, right? End of the day, like I said, the approach has to be based on the client's appropriate risk profile, combining that with his behavioral knowledge of his behavioral traits, because we've come across times when you would say a client is saying he's conservative, but actually when you do the risk profile, it's just opposite, and vice versa. So sometimes these don't match. So the definition of being conservative could be very different as what we assume and what actually could be on paper. That's important. And end of the day, the foundation of this has to be, which I always tell my clients, is right asset allocation. Because with right asset allocation, you ensure that you're managing risk well, and you could have better risk-adjusted returns. And to a large extent, if I can extrapolate, inflation plus returns. So I think if you keep this, element, then you can have a more better portfolio construct for the client.
Absolutely, Aditya. I think you have very beautifully portrayed the importance of choosing the right asset allocation. But before that, identifying the risk profile of the clients. And you have rightly mentioned there are so many new asset classes that has been coming up, along with the traditional ones like gold, real estate, and bank deposits. And with that, I see a lot of younger investors, very young investor profile also coming into the picture. So for them, how do you suggest they should capture the growth in their portfolio? And do these clienteles have a higher risk appetite than what you have seen traditionally for all other clients?
Yeah, so I'll answer this question in two parts. If you look at a country like India, traditionally, any family in India would have a portfolio which would be centered around gold deposits. And the third is approximately, you cannot ignore, is real estate, right? I think Indians love real estate, and you have a lot of investments which are there. So these are the three classes where they have been, traditionally building the portfolios. But so if I look at the parents, our parents and all, so they had kind of a preference for these asset classes, and to a large extent, that generation is very limited in terms of the knowledge part as well. But now coming to the second part is that when you're looking at the younger generation, which we're seeing, we are seeing that the younger generation has a very increased appetite for risk, and they want to explore a lot more. What is important here is that while they are open to investing in different asset classes, be it alternative assets like PMS, AIF, or emerging asset classes like REITs and maybe crypto. I would come to that a little later, right? Obviously, it's a proportion of how much money you have to invest. That's there. But you do see an increased appetite among clients or a younger generation, 30, 35 plus, and a lot of these people have made money on the backdrop of stock options. Bangalore is a Silicon Valley of India, so you have a lot of new wealth created at very early stage in life, and these are the people who are maybe around 35, 38. And how do you kind of channelize that kind of wealth? So that is where we are seeing an increased appetite of these asset classes. And what we are doing effectively is that go back to the basics. Have the right asset allocation, quantify your goals, and those processes which I've already earlier outlined in my conversation with you. But definitely, there is a trend which is catching up in this space, and the numbers support it. The AUM under alternative investment funds and PMS has grown significantly in the last couple of years, and we see the trend to move forward.
Great. So you did mention about PMSs a couple of times before as well, and we see there's a fast gaining traction, and it's a go-to destination for wealthy individuals who are looking for higher returns. In your view, what should be the ideal portfolio allocation towards products like a PMS or an AIF? How much of the overall portfolio should be in such products? And secondly, if you are given a choice between PMS products with taxation and performance fees and mutual funds, which is still considered as a massy and simplistic product, what would you recommend and why?
Well, I think, that's a nice question, and there's no specific answer to that. But let me answer that basis how I've seen this industry, and what would the right way to move forward. So I think the first thing we need to understand is again, when you kind of start with. So I'll come to a question: how much proportion you have to allocate in each asset class. But I think we can take a step back and ask the first simple question in terms of, again, the financial goals, okay? And second, I'd reiterate, what is the time horizon here, okay? We note that not many people are cognizant of the time horizon piece, right? So that's why they kind of panic in 6 months' time. They say, when equities need a much longer time. So time horizon, quantification of financial goals, and then you have an appropriate risk profile, and then we try to answer the asset allocation. Okay, so let's make an assumption that the client who's kind of met this 3 criteria and he's like an aggressive risk profile, then he could probably look at alternative assets, because generally alternate assets are supposed to give you perhaps 2 or 3% more than traditional MFs, which are more of mass products, right? So in an aggressive risk profile, generally, a client who is in that bucket, you could probably allocate around 15 to 20% of your portfolio in alternative assets, because that's really which will give you that incremental returns over time. But what is important here, which I try to highlight for our audience, is that this doesn't mean that your mutual funds are not important. And the best way to understand is that mutual fund is really the foundation of your portfolio. You kind of start a portfolio which is built on mutual funds as an asset class because you are equity and fixed income. And then you start looking at alternative assets, which probably would give you a little higher return than your more traditional mutual funds. And then you move to layer number 2, which is PMS/AIF. Again, it's a function of liquidity, because as the viewers would like to understand, for PMS, you need minimum of 50 lakhs. And for AIF, as per current regulations, you need 1 crore, right? And then in the third layer, probably if you have an appetite, then you look at private equity/venture capital. And I'll tell you why I'm building the pyramid like this. Because if you do this, there's no way you can go wrong. Because first, you've deployed your money, which is a certain pool of capital, which is MF. So there is a lower barrier to entry. You can go with a corpus which you're comfortable with. The moment you stack it up in layer number 2, the risk reward is going up, but you need to understand that your capital commitments are also going up, right? 50 and 1 crore. And the reason why the regulator has done so, because people who are coming in that slab presumably would have a higher knowledge of the risk reward metrics in that, right? And PMS and AIF are coming in a 4 or 5 year bucket, because in any PMS, you'd like to have at least 3 to 3.5 years equity minimum. AIF is 4 to 5 years on an average, because you have lock-ins. And the third layer is private equity and venture capital, which absolutely pushes your portfolio to an 8 to 10 years bucket, because in any private equity fund, minimum is 7 to 8 years, sometimes even 10 years. Now, you build a portfolio with this laddering, no way you go wrong. But the problem is that if you kind of invert the pyramid, that is where the problems could arise. Because when you're starting, you didn't understand the nuances, and you put money in private equity, not knowing that your money was locked in for 8, 10 years, and tomorrow, suddenly you need that money, right? So I think that is important. So I think if you follow this pyramid, that build a stack first of MF, then go to alternative investments, which are PMS/AIF, and then have your private equity VC, it's a better approach to your portfolio. And obviously, the wealth manager who is advising you would be advising you along the journey of the time horizon, the lock-ins, and the risk reward involved. And more importantly, the associated costs as well, right? So I think with this approach, the viewers can really manage and build their portfolios without any shocks in future.
Great, Aditya. I think it's very easy to refer to this pyramid, and I'm sure the audience would definitely clearly remember, because it talks about how much of capital they would need at every stage, and what is their capital commitment going to be going forward when they move forward from mutual funds to PMS to AIF, and then to the third portion of private equity and venture capital funds, and of course the lock-in period. I think these are definitely the parameters one should look at before they choose different type of financial solutions. Thank you so much for sharing that insight. Moving forward to my next question, which is on ESG products. And I see a lot of rich investors are increasingly focusing on creating a positive impact through these investments in terms of ESG matrices. What's your view on sustainable investing and ESG impact? And do you also advise these kind of products?
So thanks for bringing up that question. I think this question couldn't have been more relevant in these times when I don't think so, where you have a news which doesn't talk about climate change, right? And we're going to see adverse impacts of climate change every day, and people, and more importantly, the younger generation is getting aware of it on a day-to-day basis. So the awareness about climate change, and then in terms looking at ESG/sustainable investments is catching up with HNI, ultra HNI clients, and I do get conversations centered around that currently as we talk to clients. However, what we need to understand is that India is still an emerging economy, so there are some challenges in this space. Firstly, if you see, how do you really do an evaluation of ESG or the metrics around it? Do we have a set evaluation criteria at this point in time? Probably not, right? Secondly is also the breadth of investment options, right? So today, if I have to go and offer some ESG-centric product, the only thing which is in a market like India is ESG thematic mutual funds stood in the country. You look at PMS and AIF, probably you don't have kind of any ESG theme-based product, right? So one is how you evaluate this metrics. Second is you don't have products around this, but except thematic ESG mutual funds, which again, quote unquote, are questionable, sometimes what kind of portfolios you have in those companies, because, and how do you evaluate those companies? Are you evaluating a company on ESG metrics by how much capital it's committing as part of its CSR to that space, or it's actually following that in practice? It's a gray area, right? So these are the challenges. And the third, which is more important, that given wealth management to private banking, end of the day, the clients need to see reasonable returns on their portfolios. That's a fact, right? I wouldn't come across a client who say that I don't need returns. Then why is he investing, right? So it's very important to understand that ESG-focused products, because the space is limited, would inherently offer you far lesser returns than a normal diversified equity portfolio. So if you're okay with that, then you can move to that space. So these are the three constraints in terms of returns, metrics for which there's no evaluation, and limited products, hardly any beyond thematic mutual funds. So ideally, what we are telling clients is that while we understand their awareness of this and their commitment to the cause, and all of us are committed to that, whether we bring down carbon emissions, we are cognizant. Yes, we need to do it. But on an investment portfolio strategy, how you can do that, that is where the limitations are. And these limitations are real in nature. So I think what we are telling clients to overcome this, one is to hear the clients out. So my advice would be, is that do not ignore such discussions. Hear the clients what have to say, absorb those discussions, because then you're telling that you are cognizant of that. But end of the day, from a solution, what you need to give to a client, you also have to tell them that these three constraints which are there. So within these constraints, then the only option you have is to probably give them some thematic ESG-based products, and realistically tell the clients that as India is an emerging economy, probably as the landscape evolves, you will have more options in the future. I think that's the way to navigate this landscape, because telling clients that, yes, there's a portfolio which is actually not out there would not lead to any conclusion. So I think awareness about this constraints, and then telling clients to wait and watch and allocate the capital as the regulation and more products come in future, and I'm sure they would, then they can diversify the portfolio accordingly over time.
Absolutely. So we're really hopeful that we have, many more products to come in this segment with better regulations. While you talk about regulations, another interesting product that comes to my mind is crypto assets or NFTs. And at least for the younger investors, I had seen a lot of excitement, towards these kind of products. What is your opinion or take on that? Was it just a passing fad, or do you think we still have some more interesting stuff happening in this segment?
Well, it's quite an interesting question. I think I would like to break down this conversation as to what is happening globally and then what could be what's happening within India, right? I think that gives you a better all perspective. So globally, as you see, obviously, this, whether you're looking at crypto assets or NFTs, it's an emerging asset class which has caught up well globally, right? And they have, either working on blockchain and related technologies, right? And we feel that, over the last 2-3 years, this asset class in some years has given tremendous returns. And in certain cases, because of regulator intervention or some of, online scams which are happening, people have lost money. So it's a mixed bag, right? So if I have to articulate my view globally, we are seeing that a lot more money is, chasing this sector, which would make this sector more resilient in future. In other words, this technology will evolve. What I foresee is that we can't say that crypto or NFTs would have an early death. On the contrary, globally, you will have newer technologies which will support this asset class and more investments driving that, right? So that's a trend which is happening globally, which basically means that this asset class is probably there to stay with better safeguards, better regulation, and better regular oversight, okay? Now, if we have to give a view as to what is happening in India, and that's important for the viewers as to whether we would like to allocate this to client portfolio. So my advice would be that today, as we speak, we are underweight on crypto assets as an investment class. Why? There are two factors. One, if you see the view of the regulator, and I would say be specific, the Reserve Bank of India, they don't see any underlying asset to this. And they have a negative view, right? Secondly, because of that, you also see that there are restrictions on payment gateways, which would enable investor to invest these, and the UPI or the other payment gateways. And third, in India, today as we speak, it's still viewed as a speculation or a speculative asset class, and hence attracting the highest rate of tax at 30%. You combine all of these three, would combine into a view that we would avoid these in client portfolios where we are advising our clients. However, having said that, a lot of clients we see are investing in their individual capacities, which they are. But as an advisor, I would be cautious in allocating any money at this point. Yes, but in future, once we have a clarity on the laws, maybe a more favorable taxation, maybe then the advisors can look at this space gradually.
Great, Aditya. I think that's quite a logical conclusion to the factor that it is still a wait and watch game for crypto assets. Yeah. So for all our audience here, I'm sure as you are listening to this conversation, you might have a lot of questions coming up to your mind. Please share your questions in the comment section and we shall get back to you at the earliest. Now moving on to Aditya, and the next question that I have in mind is about strategic and tactical rebalancing. What's the difference between these two, and which is more important, and what are the parameters you suggest one should look at before rebalancing their portfolio?
That's a good question, especially. So I think, what we need to understand is that, strategic allocation is basically, your core asset allocation in which you start your portfolio. It's more of buy and hold long-term approach, right? And when you're looking at tactical allocation, it is more in line with short-term trends or short-term strategies, which can give you, immediate gains. But eventually, the endeavor is to return to strategic allocation, asset allocation. So to keep it simple, strategic allocation is more of buy and hold long-term. Your tactical allocation is more of short-term, in line with certain opportunities that the market would throw to get some short-term gains, eventually to revert back to strategic allocation over time. So it's a short-term approach. That's the difference. However, it's very important to understand that now looking at the relevance, it's not to say one is better or worse than the other. I think both are important in their own ways, right? I would say that strategic allocation is really the foundation or pillar of your portfolio. And on top of that, you can always build tactical allocation, which the opportunities which might come in course of time. But strategic allocation is really the key, right? Also, second thing which we observed is that ultra HNI clients, especially the clients who are have a larger corpus to deploy, would tend to go more towards strategic asset allocation, right? You would see an opposite trend in very small retail investors. So a retail investor who has a smaller corpus, maybe a couple of lakhs, they tend to go towards a tactical asset allocation because there the only thing which is driven is how quickly you can make some fast buck. But the moment when you go up the ladder and you were talking about $1 million, $2 million, you're talking about a lot many things which is called portfolio hygiene, a goal-based couple of those high-level discussions, right, which I brought about early in this call. So strategic is more of an HNI element. Tactical could be more of a retail phenomena as well. That's more from a behavioral point of view. And we see this definitely. And you see this in the markets. You have FNOs, everybody is making that quick money, and they make losses as well. However, for the viewers, it's very important that whenever you are doing any rebalancing in your portfolios, I think the first thing to keep in mind is, what is your core asset allocation you started with, right? So if it takes you to that, closer to that goal, then this exercise is relevant, number one. So you have a goal post to reach, so you're doing some changes, which is in line with your core, strategic asset allocation. To give you an example, your core was 70% equity, 30% fixed income. Today, it's 80% equity. So you'd like to pair off 10% in equities and restore the back to the original. The second, which is the most critical element, is that very important to be understand what is the tax impact you are taking, right? So if your proportion of maybe short-term gains is too high, perhaps you may want to avoid that for the future. So the tax impact is extremely critical because you cannot ignore that and suddenly have a tax liability staring down, to you. The third element also is that apart from tax, you also have associated transaction costs or transaction fee. So if you have a kind of a tab on that also really helps. And I think the fourth way to keep it very simple, end of the day, you should ask yourself holistically, what is your payoff end of the day? So if you feel your payoff is on the positive side, go ahead with that. And payoff is nothing but a summation of the top three factors I told you above, right? So you can sum it up and get a payoff. But if your payoff is negative, then maybe you'd like to hold on for some time.
Great. So Aditya, during our conversation earlier, you did mention about different group of investors that you engage with and manage their portfolios. My question to you is, do you also come across many wealthy clients who are past 60 years of age? And how important do you believe documentation, wills or estate planning is for these set of clients? And are the people taking these things also seriously?
Yeah, I think thanks for bringing forth that question. And I would like to bring forth an important SEBI circular on that as well. So if you've seen now that, nominations in demat bank accounts and in all investment folios are mandatory. Yeah. And this has a kind of why this has happened, because in India today we have, I think, I don't have a number to peg to that, but there are maybe thousands and thousands of folios which do not have a nominee, and then unfortunately something happens, the money gets stuck because there's nobody to claim it. So that is one thing which has come from a regulator standpoint. Now, coming to the core question is that how do we help clients who are in an age bracket of 60 plus? So the first way to understand this is that these are the clients who are coming from a previous generation, right? So the knowledge or the awareness, what probably the current generation would have would be to a large extent limited. I'm saying to a large extent. Obviously, you come across pools of clients who are very investor savvy as well, who know, but I'm saying a larger portion could be very low on the knowledge piece. So it's very important to tell them and telling them the nuances of the market is always a challenge, because they're low on the knowledge curve, and how you want to adapt to technology becomes adapting to technology is a big constraint, because they've never worked on WhatsApp or technology. They don't understand that. That's a thing I'm sure a lot of us face, especially the older generation, right? Because they can't even work on a laptop, leave alone going to net banking and online. So the first point is to really handhold them and tell them that what are the pros and cons of their current corpus, okay, and really understand tell them the first element is that they should have nominees in place. And the first rule here is that they should have nominees who are relatively younger to them, obviously, right? A 60-year-old cannot have a nominee who is 70, 75 years old, because definitely he would not live for that long, right? So you should always have a younger nominee so that the money gets passed to that person, and he's in a fiduciary capacity to eventually pass it on to legal heirs. That's the single most important. Second thing, as I told you, is to have a good discussion with them and tell them that what they want to do now. Okay, investment is still one of the criteria, but how do they want to pass on their wealth to the next generation, right? So I brought you about nominee. They could probably get into small things like writing a will. Writing a will, again, is something, it's always mired in something very confidential. Many families tend to view it as something very secret. So it's important to guide them that if they need that kind of a handholding, then they should write a will, probably register that will as well, so that later on the money does not come under any legal contention. And that's an important element they need to do. So nominee is one. I talked to you about will. And then I think the third bucket would be, once they have actually done these two things, they would tell them what they want to, because it's their money, probably the requirements would be more of cash inflows, right? So a younger generation would have growth of capital. For them, I think I just lost. Yeah. Am I audible right now?
Yes, you are.
So for them, it will be more of capital conservation and cash inflows, right? So once they're clear with that, then you should build the portfolio which actually suits their requirements, right? And do a construct accordingly. So the strategy really changes significantly, which is the third element, right? If you combine these three, I think the client broadly will be on the right path.
Great. So Aditya, you've actually taken us through a plethora of financial solutions, the kind of strategies one should follow. Another very important question that I would want to ask you is, in this shifting landscape of wealth management, from the investor's point of view, how should one choose their wealth manager? That's my question number one. And the second is, do you think digital wealth advisory is going to be the way forward in the industry? Okay, I think that's a very relevant question. Let me answer the first part, which is, how do you really choose your wealth advisor, or let me say the firm? So I think for any HNI client, I'll be answering this question more from an HNI or an ultra HNI perspective, because assuming one is a private banker, you would be addressing that space. So my answer would be more into that context. I'm not addressing it from a retail perspective. I think the first thing would be really is the experience and competence of the firm, which the client should look at. Okay, how they're handling, the portfolios. Second thing probably would be also to look at what is the AUM they're managing, or assets under management, because a firm which is managing a proportionately higher AUM would have a larger, is a function of experience, because they're managing that client money. So you can connect a lot more in terms of how they're doing the work, right? The third element you would also try to look at is, what are the service offerings, right? It's very critical, because today, gone are the days when the clients are just looking at only purely investment portfolios. They are looking at a combined or a complete bouquet of products, service offerings. And the moment you look at it with that approach, you're looking at investment portfolios, you're also looking at estate planning, you're looking at tax planning, and about retirement services as well. We talked about what are the important things in the previous part. So services offerings becomes critical.
And fourthly, which would be important, is I think I strongly feel is accessibility. How accessible is really the firm or the relationship manager who is your point of reference? Because if I have to really struggle to reach out to the firm or get a response, I don't think so an ultra HNI client would prefer that. So if you combine these four, and the fifth element is compensation, how really is the firm charging the client? I think transparency around that really helps both sides, right? Because are you charging an advisory fee, or if it's a RIA model, or are you or it's embedded within the product itself, if it's a kind of a distribution kind of a setup, which is 90% of the market in India. I think if these four elements are looked in, client can make a reasonable choice.
Great.
Which brings me to the second point of your question, is phygital. So I think my sense is that both are here to stay. We are talking about robo-advisory and a lot of digital things emerging. But again, from a viewpoint of ultra HNI clients, I'd like to answer that question. It's not retail, right? So for an ultra HNI client who is committing $1 million plus, okay, I personally feel that the human interface, okay, or the human touch, which is the relationship manager, is extremely critical. Because when you're investing that kind of money, which is $1 million or $2 million, nothing is more important than a face-to-face conversation, which brings a lot more conviction in the discussion and the decision which the client is going to take. So I personally feel that is there to stay. But having said that, like I mentioned to you in the earlier part of this conversation, how the client tracks the portfolios and how he does his investments or how he executes his investments is where the digital landscape is critical. And I would say the word technology would be the foundation on which a digital landscape is built. So that is equally important, right? So for an ultra HNI client, I would have both of them being relevant. But yeah, if I have to look at the weightages, maybe I would say that a digital or a technology landscape could be probably taking a 60% weightage, but I would still give a weightage of around 35 to 40% to the human touch, which I think is there to stay for the years to come.
Absolutely. So Aditya, you have actually summarized most of the points very beautifully after each question that we have discussed. But if you want to summarize your entire wisdom into three most important messages that you would want to give to our viewers, what would that be?
Well, I think, that's a good question. And I was just kind of, trying to summarize my thoughts, as we look at forward. So I think my first point to summarize is that always quantify your financial goals. Okay. And again, I'm stressing on the word quantify, because the more you have a number, it's easier to do the back of the envelope calculations to reach that goal. And always combine each financial goal, with the time horizon, right? So that's point number one to summarize. The second piece, which I would like to bring in, that once that point is clear, then number two, do the right asset allocation, right? And when you do that, then you know what proportion of equity, fixed income, and alternatives you have in your portfolio. And the third, which is the most critical element, is that once you've reached these two, it's very important that you do a periodic review of your investment portfolio, right? And just for the sake of the audience here, I would say that review once in a quarter is a good way to get started, right? Why I'm putting quarter, because there's no point reviewing a portfolio daily or every week. That's not the way it works. If you start with a quarter or even once in 6 months, that's good enough. And to ensure that your investments are on track and in line with your own goals. I think these are the 3 points to summarize.
Great. Aditya, thank you so much for joining us today and sharing such power-packed insights on how to manage wealth through the changing dynamics of wealth management in India. And I'm sure our viewers have benefited a lot from your advice and expertise that you had shared. To all the viewers here, if you need help managing your money, click the link in the YouTube stream and we will contact you ASAP. And yes, please don't forget to leave your feedback about this conversation. Thank you so much once again, Aditya, for joining us. Have a
Thank you
very
so
nice
much.
day.
Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.